was a big announcement yesterday. Many analysts came out and called it a transformational shift. Whether or not analysts liked it or they didn't, one thing that I saw that kept cropping up is that an integrated energy company. How does that not eventually make you guys a utility company?
Alex, good morning, and thanks for having me on. Yes, an exciting day for us yesterday, and as you will remember, as you were there on the day, on the 12th of February, we set out an ambition to be a net zero energy company by 2050 or sooner, and to help the world get there. And of course, you know, rightly, a lot of people had a lot of questions. They said, nice ambition, but it lacked detail, and we said we'd come back later in the year and give them the sort of route march, and that's what we did yesterday. So we filled in the details, we laid out a new strategy, which we'll talk about, a new financial framework, and a new distribution policy. In terms of the integrated energy company and how we don't become a utility, so to speak, what this is about, Alex, is the problems in energy that the world faces are increasingly complex. They're local, they're complex. People are looking for many things from energy. They're looking for it to be reliable, they want it to be clean, they want it to be affordable. And to do that, you actually have to knit together lots of different energy sources. And that's where BP comes in. Plays very much to our strengths because we're in natural gas, we're in solar, we're in wind, we have one of the world's largest trading organizations, and we can knit this together, giving customers what they want, cities, industries, commercial companies, and enhancing value as we do that. So that's our strategy, to be an integrated energy company providing solutions for customers. And I think it plays well to our strengths.
So that though to me does sound very much like a utility company, even though you may be bigger. So what's your differentiator?
So we do not intend, for example, to do power generation or power transmission in regulated markets. We do not intend to deal with consumer retail customers. We don't believe that's where our strengths are. But where our strengths are is what we've been doing actually in North America for over 20 years now. We're well known, and you know us, Alex, as a natural gas producer in the United States. What people don't know is that we sell over 20% of all natural gas in the United States, and more importantly, that we have been providing energy management to over 100 cities in the United States as BP for many, many years. Now, what those cities want is they want clean power. Now, how do you get that? You get that clearly through wind, through solar, and maybe with a blend of natural gas, because that wind and solar isn't giving them the reliability that they need, and natural gas can bridge that. They also want to be able to predict the price of that, and because we have a large trading organization, we can hedge that price for them. And obviously they want it to be 100% clean, and as one of the largest traders in carbon credits in the world, we can do offsets for them, sometimes through our own and sometimes through the marketplace. So if you put yourself in the shoes of a city, or if you put yourself in the shoes of an Amazon or a Microsoft, each of whom we have or are working on deals with, they want that solution, and they don't really want to look behind the curtain and knit together 6 or 8 things. They want one person to go to, and that's what we do.
So I'm glad you brought up your trading. I've been to your trading floor in Houston, and it is huge. The trading arm of your company did really well, as we've seen with other oil companies in the last quarter. Can you give me some insight into if that continues? I mean, I could argue that maybe Contango was a big part of that. Can you give me some insight into that arm for the back half of the year?
Yeah, I think we had a strong quarter, a very strong quarter. I think we called it an exceptional quarter in trading. It was one of the few highlights of the business in the second quarter. We're very fortunate to have an incredible trading organization that's global. I don't think that level of performance is rateable. The second quarter was probably one of the most challenging quarters in our industry's history. And it played well in a market where there was a contango. It played to people who have deep capabilities like we do. It plays to people who have infrastructure positions like we do. So a very strong quarter, but not one that we would expect to be repeated.
All right, fair. What I also was struck with yesterday is when you guys were talking about returns, and this brings into account commodity prices, is that by your own admission, you basically say that power projects make a lower return for oil and gas investments, but overall you still see higher returns of 12 to 14%. How much of that, though, is 100% predicated on, say, $60 oil, and what happens if we stay at 45?
Yeah, it's a good question. I mean, yesterday we laid out that the distribution policy and our commitment to shareholders has sort of three elements to it. Number one, committed distributions, which is a reset dividend and a commitment to do share buybacks. The second is profitable growth, which is the returns growth that you mentioned, as well as EBITDA per share growth. And the third is around sustainable value, where we're actually saying here's an opportunity to invest in a company that is decarbonizing and helping the world decarbonize. On returns, I think in the early part of this decade, it's driven very much by our existing hydrocarbon business. As we head into the second half of the decade, you will see that those new businesses come to the fore. We're optimistic about what we can do in this space. We've said that we expect to go from about 2.5 gigawatt of power to 50 gigawatts. We've talked also, it's not just about renewables, it's about the consumer and the mobility into the business, which we said yesterday is probably in the region, Alex, of 15 to 20% return. So our transition story is not just a renewable energy story, it is also a consumer story, it is also a mobility story. And people may not know, BP sells coffee. We sold 150 million cups of coffee last year. That's a third as much as Costa does. This is a very strong business. It's a growth business. We're going to go from 10 million customer touch points a day to 20 million over the next decade. So we're as excited about that as we are about the low carbon energy part.
But Bernard, don't you still need $60 oil to make all that happen? Because you need the cash flows from your oil and gas assets to make all this work.
So what we did, Alex, with the distribution policy reset is what we wanted to do is consistent with strategy. And this decision was rooted in strategy, absolutely rooted in strategy. We want to become an integrated energy company. We need to invest into the transition. To do that, we want to be able to do it at a range of prices. And what we set out yesterday is a framework, a financial framework that has a balance point of $40 oil. So we can do these things at $40 oil. And by the way, if oil is less than $40, we will take actions to preserve that. So what we've laid out is a very resilient distribution policy that enables us to invest into the transition while giving shareholders a fixed dividend and the potential for at least 60% of buybacks if there is excess cash flow.
And obviously a big part of that is sort of how you decarbonize in many ways in terms of lowering your oil and gas production. What's on your Post-it note of assets to sell?
Well, you might expect it to be very difficult for me to answer that question, but it is a core part of what we laid out yesterday. We are going from a business that, Alex, over 100 years has been predominantly defined by two commodities, oil and gas, predominantly defined by two businesses, an upstream and a downstream business. And we're heading into a company that has a much more diversified energy mix with two growth areas, low carbon electricity and energy, and convenience and mobility. And at the same time, that hydrocarbon business, which is really enabling the strategy and fueling the strategy over the next several years, we will see that business shrink and we will see our emissions shrink with that business. And as you point out, we're saying that we'll see about a 40% reduction in production over the next decade, and that will come predominantly through divestments. We were at 2.6 in 2019. We're already at 2.4. We sold our Alaska business, and we obviously have a long list of things that we can do, but we can't go into that detail today.
Can you maybe tell me if you were going to put capex into oil assets, what would be the priority?
Well, I think we are looking clearly for continued investment. We've made that very, very clear yesterday. About $9 billion per annum in the near to medium term will continue to go into our hydrocarbons business, which is a combination of our old upstream business and the refining business. we're looking for probably two things. We're looking for quality. We've increased the thresholds that we demand from the hydrocarbon business on our investments. We've shortened the payback periods that we require, so we won't do an oil investment in a completely new facility unless we can see a payback within 10 years. So we've really ramped up the quality of the return that we're expecting. And secondly, we want to make sure that we can continue to make it more environmentally efficient. And we were continuing to do that, and we have lots of plans to do that. So we will invest. It will only be in what is the highest quality, and it will only be in that which we believe we can do on an accretive basis, on an environmental basis.